But I just want to be careful with these kind of things and saying these kind of things, because just like the debt ceiling, it's clickbait. It's completely insignificant, the amount of this or that country that might be buying U.S. or selling U.S. Treasuries. U.S. Treasuries are the world's highest yielding debt, the deepest market right now. If you're short the dollar, it's a negative carry trade. It's not that complicated. And I've heard it since I've been in this business. I don't know how many times, oh, I got to short Treasuries because the debt's going up. First of all, let's start with the trend. It doesn't matter right now. We're all turning to Japan. It will matter at some point. That's why Bitcoin is long-term I'm bullish. But right now, the biggest bridge that we have to cross is, as Dave mentioned, we're tilting towards this recession. What typically happens in recessions is the Fed cuts aggressively. This is not an opinion, that's a fact.
According to Bloomberg Intelligence's senior macro strategist, Mike McGlone, the second half of the year could potentially be bearish for Bitcoin and the overall cryptocurrency markets. McGlone suggests that risk assets, including stocks and crypto, may become more affordable in the upcoming months due to an anticipated economic recession. He points out that the Federal Reserve's ongoing path of increasing interest rates could have a negative impact on the performance of Bitcoin and other crypto assets. McGlone highlights the cat and mouse game between the stock market's rally and the actions of central banks as a potential obstacle for risk assets. Furthermore, McGlone mentions that the Bloomberg Galaxy Crypto Index failing to sustain above its 2018 high in 2023 may have valid reasons, as the Federal Reserve continues to tighten. He states that the Bloomberg economics team is predicting a challenging second half for cryptocurrencies and equities, noting a rare divergence with the Nasdaq 100 stock index breaking higher while the BGCI is falling. Rising rate hike expectations, as indicated by the federal funds futures, could potentially limit the growth of crypto prices. McGlone suggests that the recent rally in the BGCI, around 50% by June 1st, and the Nasdaq's 30% increase may shift the bias towards the typical behavior observed during recessions, where risk assets become more affordable. In the video, McGlone shares his macro insights on various topics, including the Federal Reserve's rate hikes, the debt ceiling, and the current state of cryptocurrencies, with a particular focus on Bitcoin.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
Key thing I keep watching is every time I look on the Bloomberg terminal, I see we still have these bars that show they're going to be hiking in the July or June, July meetings, and I look at that and there's really no chance I see of things like an end to this deflationary forces we're seeing in commodities. Bloomberg Commodity Index is down almost 30% on a one-year basis. We're seeing a little bounce in crude oil today, but I don't really see an end to that until you get well past an easing cycle. And we're not even started yet. So we heard trickling every day now. We've seen trickling downward in China, which has been my expectation for years, but not doing very well. And of course, they just pissed off their best customers, Europe and US. So that's kind of a problem, major disinvestment. But in the shorter term, the key thing is about OPEC plus meeting cuts this week. And it's silly how people who are still trying to play that bullish game in crude oil, yet it's been in bear market since 2008. And I did say 2008 because that's when it peaked, and last year made a lower high. And people keep looking for that old scenario by looking at this old supply side that they still matter, but less so every day. And so we're getting a bounce again in crude oil, and that's what's been happening. We get a bounce on the OPEC cuts, and then it goes back downward to trend. So I see crude oil right now, it's pushing towards 75. It's still going to head towards 50. Natural gas has already done the equivalent. Commodities always go towards their cost of productions in the long term, particularly when you've seen kind of dicey inflation or economic demand, which is not so great. So they always go towards cost of production. And the key thing I'll end with that's so important we need to point out is cryptos are showing divergent weakness now. This is on a quarter, on the whole quarter now. Q2, the Bitcoin's down 6-7%. Bloomberg Galaxy Crypto Index is down about the same, and the Nasdaq's up about almost 10%. That's a sign of divergent weakness. Now, people keep saying the correlations have broken down. I'm like, yeah, they're breaking down the wrong way. The fastest horse in the race is warning everybody, warning us that there's a problem. I know I have to say this very carefully on this program because we all have to listen to ourselves and our views. Is more McGlone saying what we don't want to hear, or is McGlone saying what he really thinks and warning us? And this is one thing we always have to be careful. I add it myself as a trader and ex-trader, not like Dave who still runs money and you. I'm not out to I have to point facts of what's happening. And I have to sometimes, I know in 2018, a lot of crypto people get very upset with me for pointing out facts and my views, but this is a fact in crypto space. My sense is most people think the worst is over, yet there's a good chance it might not be. Back to you.
In McGlone's market analysis, a notable observation is the unusual weakening of Bitcoin, copper, and equities in China when compared to the resilient Nasdaq 100 stock index. Additionally, the fact that the Nasdaq's performance alone has the potential to uplift the entire market contrasts with the rising expectations of a Federal Reserve rate hike. These factors lead him to conclude that, despite its strength, Bitcoin might be too young to outperform traditional safe haven assets like gold in the event of a U.S. economic contraction. Furthermore, McGlone emphasizes the importance of not basing investment decisions solely on the opinions of random influencers or self-proclaimed trading gurus. He advises against relying on such sources for investment advice, highlighting the need for careful consideration and analysis.
For 40 years, we've had a blip, and we're heading back down. But there's key things sometimes that Dave and I have learned that's inherent in what we do, and that is absorbing, studying, and listening, and reading, and studying headlines 24/7. And it's something I've been doing for decades. And when I just saw that headline this morning, big U.S. banks face 20% jump in capital requirements, it's like, I'm not going to bother to click through that story. I just look, okay, the macro is already bad. We're already seeing a major jump in money leaving banks and going to money markets and two-year notes. And it's classic fractional reserve bank contraction. It's just, you can't face it. It takes a while. And then I see that headline, okay, well, let's just throw gasoline in that fire. So I just don't, it's one of those things that also you have to also remember in this business. It's very important to focus on the forest of what you're looking at and ignore those little trees that'll knock you off your view. And that's what I see. The stock market's a pretty good tree lately, but it is actually, I think, aggravating my macro view that this is the biggest reset of a lifetime by keeping that Fed emboldened, by keeping those rate hikes still hanging on over ahead, as so many other things are collapsing. And the people focus on the lagging things like unemployment. That's so not important. Let's look at the producer price index. The fact since 1948 it's never dropped as fast as it is now, and then I say that as a fact, should scare me. It should scare everyone. And what is being done to help alleviate that? Nothing. It's still going that. And the fact that we're having bank deposits on a year-over-year basis drop at the biggest, the highest rate in our database since the 50s. And what's out to stop that other than maybe just a pinprick every time one or two banks fall? Nothing. The macro's still bad. That's why I look at the big picture. You have to think at least 12 months forward. And that's where I'm still concerned that you see the Fed funds rate 12 months is still around 5%. And that's still restrictive because if I'm going to get 5% and guaranteed 10% in 2 years, why would I invest in any risk asset, particularly if you start rolling over it, cryptos have been doing. Treasury is the most leveraged market on the planet. You can get that financing for just about free. But to me, this is also part of the macro. Let's ask ourselves, can we not expect a reciprocal response to the biggest liquidity pump in history that's dumping at the greatest pace in history? And we've never raised rates this fast on a global basis. It's just logical, yet the market's already priced that, it's okay. But that's human nature. And you pile on, like this analyst is bullish and that analyst is bullish. And I love hearing these strategies when people say, yeah, but so-and-so said this. And I say, well, what's their vested interest? They have a vested interest in being right and selling you that crypto or selling you that stock market going up? Or the crude oil going up and being right, or is it follow what they're paid to say these things? You hear these major strategies from major banks coming out with these bullish economic things. I'm like, that's the difference with me. I'm paid to be right in the long term.
Saudi Arabia has announced a significant cut in its oil output for July, as part of the broader OPEC Plus agreement to limit global supply until 2024. The country's production will drop to 9 million barrels per day, down from around 10 million barrels per day in May. Saudi Arabia, as the only OPEC Plus member with sufficient spare capacity, aims to stabilize oil prices by adding an element of unpredictability to the market. OPEC Plus, which includes the Organization of the Petroleum Exporting Countries and allies led by Russia, collectively produces about 40% of the world's crude oil. The group's policy decisions have a substantial impact on oil prices. While the surprise supply cut in April briefly lifted Brent crude by around $9, prices have since retreated due to concerns about the global economic weakness and its effect on oil demand. At the end of the week, Brent closed at $76 per barrel. Saudi Arabia's ability to quickly adjust its output levels sets it apart from other OPEC Plus members. The country swiftly responded to excess supply during the early stages of the pandemic by implementing record output cuts. In addition to extending the existing cuts, OPEC Plus agreed to further reduce production targets from January 2024, although some adjustments were made to align targets with current production levels. As the global economy faces challenges, cautious analysis is essential for navigating these volatile times. The next Federal Reserve rate hike remains uncertain, and opinions and predictions on this matter are encouraged in the comment section below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.